my name is Dana Golden. We're going to finish up capacity market basics with a look at the cost of new energy entry, or CONE. CONE refers to the minimum cost a new generation resource must recover in order to cover its fixed costs and variable costs while providing a competitive return on investment. This is critical for determining the viability of new generation technology in electricity markets. It includes capital costs, fixed operation costs. It includes return on investment, and it includes financing costs. This is something, return on investment is part of what makes this different than LCOE. In LCOE, we're just looking at the cost to return your money. But here, we're saying specifically, investors require some sort of return to finance the plant's construction. So this is the cost that is required for the plant to want to be built and get built. And then financing costs are the costs associated with borrowing the capital to fund construction of the plant. So ROI, if you remember back to our cost-benefit analysis structure, is the cost of servicing equity, and financing costs are the cost of servicing debt. So the calculation of cost of new entry is calculated by summing the following components: capital cost. This includes the construction equipment costs required to build the plant. Typically it's stressed per megawatt hour, depending on the plant's expected output. And then fixed O&M costs. These are the costs for operating and maintaining the plant regardless of generation level, typically calculated on a per unit or per megawatt basis. Then you add in return on investment, the required return on capital in the project, typically a special percentage. Then you finally add in financing cost, the costs that account for the interest on debt used to finance the plant construction. So you can calculate this as a way of adding cost of capital. So you can include both debt and equity, or you can think of return on investment as the equity piece. You can do this different ways. I tend to use return on investment is equity, financing cost is debt. We could have financing costs include debt and equity, and return on investment focus on market returns of specific kinds of equity. The overall CONE can be represented as the sum of the cost divided by the capacity factor times plant lifetime. The capacity factor is the ratio of the actual output to the potential output, and the plant lifetime is the expected operational life of the plant in years. So let's calculate cost of new entry for a new natural gas plant given the following parameters. Capital cost $1 million per megawatt. So notice, unlike levelized cost of energy, we've already divided and put these things in terms of megawatts or megawatt hours. Fixed O&M cost, $50,000 per year. Required return on investment is 10%. Financing cost, $20,000 per megawatt per year. Calculated based on the weighted average cost of capital. Capacity factor is 85%, and the plant lifetime, 25 years. So we calculate the annual fixed cost. So we have annual capital recovery, capital cost times ROI. Calculate the total annual cost, annual capital recovery plus fixed O&M cost plus financing. Total annual cost, we add this all together to get $175,000 per megawatt per year. And then we divide this by the capacity factor of the plant lifetime to get a CONE cost of new entry of $8,235.29. So the CONE for this natural gas plant is this. So CONE is pretty central to capacity markets, and the elasticity of CONE refers to the responsiveness of cost of new entry to changes in key market or regulatory factors. It reflects how supply side investments react to changes in cost of market incentives. So this is determined by capital costs, the variability of equipment, construction, and financing costs. Market dynamics, high market prices reduce the effect of CONE by increasing the expected revenue from entry markets. So I should mention, I don't think I've done it now, cost of new entry is essentially the missing money problem. It's how you expect the marginal generator, the most expensive generator, to have to be compensated in order to be there if they're not expecting to get money from the day-ahead market. So high market prices reduce the effective CONE by increasing how much of the money you're going to get from the energy market. So this is about how much you have to pay people to be there if they're not expecting to get a lot of revenues from the energy market beyond their variable cost. And then renewable subsidy carbon pricing can alter relative costs and bring down cone elasticity, or can change cone elasticity. And then technological evolution, innovations in generation and energy storage can lower cone over time. So low elasticity means supply is less responsive to changes in market conditions, potentially leading to capacity shortages. This indicates a high barrier to entry, like that is regulatory, technical, or financial. And then high elasticity, supply adjusts more readily, stabilizing capacity markets. It promotes competitive market outcomes and efficient investment. So elasticity of a cone helps determine the sensitivity of market prices to demand changes. Higher elasticity leads to smoother adjustments in capacity markets, reducing price volatility. It's challenging to accurately estimate elasticity requirements because reliable data on cost, market conditions, and regulatory impacts is hard to find, and long lead time for capacity development can reduce apparent short-term market elasticity. And so the impact of renewable energy on resources on reliability can be mixed. Of course, it diversifies the resource mix so that problems that might emerge from natural gas won't be there for this particular type of resource. You reduce the dependence of fossil fuel, which you mitigate the risk of fuel supply disruptions and price volatility. And you have decentralized generation, meaning you don't have as much reliance potentially on local transmission capacity or local distribution networks. But you also have a challenge to reliability because of the intermittency problem, because they're not predictable. It's difficult to accurately forecast. You might not be able to match them up to supply and demand. Some of them, like solar PV, don't generate inertia, which we talked about in the Bidding on Electricity Markets lecture, which challenges frequency regulation. And then finally, renewable resources often are located far from load centers, which can require substantial transmission investment. So there's a question, and of course you can mitigate these through energy storage, demand response, enhanced grid flexibility, greater investment in infrastructure, smart grids, and transmission, and complementary resources, using flexible generation sources to stabilize the grid. There's a question as to whether or not renewables should even be able to bid into capacity markets, and if so, how they should be penalized for the fact they can't be available. Doesn't that affect how